When a client comes in and they're looking to invest in a renewable energy project and it's still in the development stage, they're going to look at the models of what cash is coming in from the investment banks and what the return is going to be in the form of tax credits that's allocated to them, and figure out what that's going to do on their return. There are production tax credits that you can take advantage of, investment tax credits. Historically, those credits become available when you actually start the facility, you get it put in place, and it's up and running. The problem was that developers oftentimes are doing it on a project-by-project basis, and so they don't have a lot of taxes that they need to offset with the tax credits. So what developed was a market so that they could essentially sell those tax credits, and they were typically going to the investment banks. They would do basically what's referred to as a partnership flip structure. They would basically allow the investment bank to put cash into the project. They would essentially, as the developer, take the project out, and then part of the return that the investment bank would get would be the tax credits that they could use because they're paying, cash taxes in the U.S. So what we would do is we would help the client understand, based on their investment objectives and the specifics that they're looking at, what the tax implications are going to be. Another area besides renewable energy that's very popular right now in infrastructure is public-private partnerships, or P3s as they're commonly known. They're starting to become more prevalent inside the U.S. as a lot of the states are under tremendous budgetary constraints, looking to raise capital. So you've seen various toll roads, for example, that have done a P3s for. Oftentimes, when you're looking at those structures, you're realizing that if it's structured properly in the first several years, you might not have any cash taxes to pay. I think the key takeaway when you're talking about infrastructure deals is that tax is a real driver. And unlike other deals where tax has a role, in infrastructure deals, it's really a prominent role because the tax piece of it really drives your returns, it really drives your cash flow, and has a lot of impact on the deal overall.